Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M, as you know, is the first and only global virtual accelerator for technology startups. Our mission is to help 1 million entrepreneurs reach $1 million in revenue, annual revenue, and beyond, build $1 trillion in global GDP and 10 million jobs. In support of that mission, we do these free mentoring roundtables week after week after week. This is the 567th episode. We started way back in 2008 with an experiment with online mentoring that then blossomed into a much bigger 1 million by 1 million program in 2010. So we've been at this for a long time. More than 200,000 people have participated in these sessions. All recordings are available on the 1M1M Roundtables channel on YouTube. On Twitter, we're at 1M1M and at Stravana. And today's hashtag is 1M1M. These are the call-in instructions. It is a roundtable, not a broadcast, so we want you to participate as much as possible. So to begin with, participate through the public chat and Q&A, and then I will open up. We have scheduled programming first, but I'll open up the line for Q&A later. Today, we're going to start the session with a discussion with Zain Jaffer, partner at Bluefield Capital. I have known Zain for a while. He was in our Entrepreneur Journey series as well. You may have already read that story. Zain, welcome to the show.
Thank you for having me. Good to be on again.
Zain, tell us a bit about your, I guess we'll focus today's work primarily on the investing activity that you have more recently started. But if you want to set some context for people about your fascinating entrepreneurial background, that would be great.
Sure. I would call myself an entrepreneur in terms of, as soon as I discovered computers, I started to mess around and code and design things. So I've always been at it, trying to build things. And sometimes it's worked out, right? Most of the time it doesn't, it fails. But I've had, a lot of attempts, and all you need is to be lucky once. And it can, change your life completely. So I had a big exit. It was $780 million back in 2019, where I started an advertising tech company. And after that, which sort of has seen me transition from being a founder operator into more of a capital allocator or VC, I set up my family office where I started making investments, and then I decided to professionalize that. And I joined a fund called Bluefield Capital, and I set up a venture capital fund. Our focus is more unique because we invest in PropTech startups. So these are startups that target the real estate sector.
And why did you choose this sector? What in your background or in your history leads up to this choice?
I'd say it's envy, right? Or jealousy. As a founder, your entire net worth is tied up in your one illiquid startup stock. And it's a crazy journey. Sometimes you just want stability. It takes a toll on you when your net worth fluctuates like that, and you could lose your entire, you know, not even life savings, your investors' money, right? When you raise tens of millions of dollars from investors, it's scary. So I saw on the other side, you've got people making money in real estate, and frankly, they're not doing much.
Yeah.
They're leveraging up, they're getting great terms, they're getting cash flow. I wasn't even taking the salary for so many years. So it was very tough seeing, other people make really good returns, take their salary. I was like, I want a piece of that. But, here I am, no salary, banking with investor capital, trying to grow something big. And I also saw the returns. And the returns are amazing in real estate. And it feels like you don't have to do much. Things just keep appreciating. So I really wanted to get into that. And I felt that once you reach a certain level of wealth, real estate becomes a core part of the portfolio that you have. You'll have stocks, you'll have bonds, you'll have alternatives such as crypto and startups, venture capital, but also real estate. And I also realized a lot of people seem to be making money in real estate. And I got to tell you, now that I'm on the other side where we're buying real estate, you make money because it's so broken. 50% of the people don't know what they're doing, which is why it's kind of easy to make money, right? But also a lot of information asymmetry, And the market seems really ripe where technology can come in, can create transparency, can automate a lot of processes. It's just, to use stereotypes, a lot of old white money, at least in America. And
Mhm.
when you have a situation like that, it's exciting because people think the old school way is a mentality of don't fix it if it ain't broken. And I just thought to myself, okay, one of the world's largest asset classes, hundreds of trillions of dollars in real estate, clearly can be run more efficiently. And so I just thought, massive opportunity. Ultimately, I thought I want to start a company in this category, but to start with, let me be a VC for a while. Let me learn the dynamics of the industry, and from that, I'll figure out where to go next. And I thought we're in a unique position because I'm buying real estate via Bluefield. Bluefield has billions of dollars worth of real estate in its portfolio now. We have a lot of multifamily apartments, hospitality assets, which means hotels. We have senior care facilities. We have industrial warehouses. We're doing construction. And so, whilst I'm there, when I'm buying real estate, I thought, what a great platform to be a strategic investor and also set up a venture capital fund. And it's sort of I sort of felt, and this is probably my founder mindset when it comes to VC. When you start a company, you want to find a niche. You don't want to go after like something everyone's doing. You want to find a really, really, niche area where you feel like you've got skills and expertise that can match it. So my thesis was, when you look at the venture ecosystem, you've got these very large generalist funds that have an unfair advantage against all other funds. They can deploy capital at immense amounts. The cost of capital is lower. They've got huge amounts of capital under management. They can be broad sector players and they can afford to come in later stage. Normal VCs are getting crushed under that mentality. And so
Mhm.
if that's one end of the spectrum, on the other end of the spectrum, you have niche players, players that are either geographically focused or sector focused
Yeah.
or size focused, like pre-seed accelerator is size focused, right?
Yeah.
Or we only do pre-series A, or we do secondary, that size, but that's still not enough. So then you either become the local person where I invest in everything in, you know, Utah, Salt Lake City, where I invest in, only Silicon Valley startups, or it's sector focused like we are, where we only invest in real estate focused startups and at seed and early seed. So that was my thesis that we come into the venture game and have an unfair advantage. And it's an unfair advantage also not just because we're sector focused and stage focused, but we have real estate in our portfolio. So theoretically, we can test we can run pilots, we can get superior due diligence. I kid you not, I've seen VCs in the prop tech ecosystem get pitched I don't know, a retail concept or an apartment concept. And what do? They call their residential broker who bought their $50 million home in Atherton. And they asked the residential broker, what do you think of this idea? Those VCs, frankly, I mean, not all VCs. There are some amazing VCs in the sector, but when you have so much sort of generality, you're not going to be able to do better. You're not going to be able to do superior due diligence usually. So I felt we've got an edge there.
Okay, so let's focus on the prop tech part of your work. And you said you're doing what, pre-seed and seed in that
Yes,
sector? Yeah.
exactly. Yes.
Okay. And is it all United States, some specific part of United States? What's the geographical boundary of this?
We try to stay focused on the US markets, but we are also open and have done many companies, maybe one third of our portfolio now are companies who plan to expand to the US, or they may be based anywhere in the world, but they just happen to have US customers. And, it's a key strategic market for them. Ideally, the US is the top focus, though, or is
Got
going to become the major revenue driver.
Okay, so now I'm going to double click down on prop tech and how do you analyze the prop tech trends? What are the key trends? What are the key developments in the market? So give us like a little primer on prop tech.
So much opportunity. Look, when I started my company back when apps were taking off, as a founder, I looked at maybe five different areas and I had to pick one. And I kid you not, every single one of those five areas resulted in multiple unicorns. Even the top five companies in each of these five categories became unicorns. When I looked at real estate and prop tech, there were like 50 categories. So to me, it was like, wow, what a great time to be entering the industry because even if you're not the number one player in a part of PropTech, the market is so large that it can support multi-billion-dollar outcomes. When you try to analyze the PropTech ecosystem, there's a few ways to do it. One is based on workflow, where you look at the stages of work that's required in a transaction. The other way to look at it is by dividing it into asset classes, and you can sort of apply this matrix structure. So I'll give you an example. Let's start with the easy one by asset classes. Okay. You can just simply take a map of the real estate ecosystem, and you can say there is residential, which is the largest segment, and that's driven by consumers primarily, and it's got an ecosystem around it. But you also have commercial real estate investment, and within commercial real estate investment, you have multifamily apartments. And even within multifamily apartments, you have Class A luxury high-rise skyscrapers. You have workforce housing where you have Section 8, and I'm using American terminology here, but the equivalent of that is, where it's supported by the government and subsidized and it's low income. And you can zoom out again and you can do the same for hotels. You can do the same for senior care facilities, industrial, or alternative real estate, or government real estate. So that's one way to dissect the PropTech ecosystem, to find startups that are focused on what I would say is a niche, but conveniently a multi-billion or multi-hundred-billion-dollar niche. The other way to look at it is based on flow. And again, you can apply this matrix to any one of these individual sub areas. So I'll give you the example of a workflow for a company like ourselves. Newfield primarily has, as I mentioned, billions of dollars of real estate in its portfolio. Here's the workflow. Number one, you need to identify assets. How do we identify assets today? Word of mouth. And there is an amazing opportunity to think about different startups that can help with the identification of assets. Then you underwrite assets. How do you do it today? You use spreadsheets and you use your gut. Literally, it's your gut. You see so many real estate deals where eventually it's like comparing shoes, right? Oh, this feels like a good place. I feel really good about this. Let's go in and buy it. I mean, technology definitely can be used there, and AI can be used there, right? Now you've looked at real estate, you've identified it, you've done the underwriting process and analysis, and there's brokers involved there too sometimes. Okay, then you think about how do I actually manage this, and that's where you get operations. And within operations, you have things like property management. That means collecting rents. That means undergoing renovation projects. It might be construction and renovation, which are huge areas for disruption, right? So I'm zooming out now, right? So you've got management of the asset and evaluation analysis. And then what you have ultimately is the disposition of the asset. How do you sell the asset? The buy side, the sell side, the transaction side. And so that's an example of a workflow-based approach. And when we started out with creating this venture fund, we thought, let's try to be more efficient in our workflow processes. Because, ultimately we're a strategic investor. And when you come across a strategic investor, they look at the world differently than a traditional venture capitalist. What I would say is that as time has evolved, our view has evolved too, where we're not going to be able to run pilots with every company that we want to work with. By the time I finish running a pilot with a startup in our portfolio of, hotels, for example, they've already got so much traction, they've probably raised the next round of financing. So we now think more like generic VCs where it's based on broader trends. But we do like to find startups where there are synergies with our own real estate portfolio.
Now, as you are looking at this space, what is the scope and scale of the number of startups operating in North America, let's say in the US? How many startups are operating in the PropTech space?
I saw about 500 startups last year, and that's just through what I tracked in my CRM. And there are thousands of startups. These are startups that were actively raising capital. So the number is mind-boggling. But of course, I think with any industry, there'll be a lot of players, only a few will make it. So the number is enormous. I don't know what the actual number is, but PropTech is becoming a big segment. PropTech actually evolved. I would say it was a niche segment that was the intersection of fintech and maybe marketplaces and potentially on demand, the economy. And also construction, which is an even smaller niche. PropTech is now standing out as its own niche. Most of the venture dollars that have been deployed over the last few years have gone into fintech. And I
Mhm.
think now that fintech's becoming very saturated, and I don't mean saturated as in opportunities, I just mean there's a lot of dollars chasing fintech, right?
There's a
PropTech,
lot of dollars chasing fintech.
right. So PropTech, I think now needs to be broken out of fintech and needs a specialist uh, perspective. And even within PropTech, you get specialist funds that are dealing with these different segments. Look, the answer is I don't know how many startups there are, but there are lots of startups, and there's no shortage of deal flow on the VC side for sure.
Yeah. No, I mean, we've seen a couple of prop tech startups within our portfolio. So one in augmented reality and one in marketplaces. So we have these companies in the portfolio right now. So yeah, we are seeing prop tech. Now let's do a couple of case studies of companies that you have invested in prop tech. And as you're talking about them, I'm sure you're excited about the value proposition and so forth, but I also want to understand how they came to you, in what shape they came to you, and what did you see in them that drew your attention sufficiently to want you to write checks?
Yeah, so we partner a lot with early stage accelerators and incubators.
Mhm.
There seems to be this gap still at the pre-seed and almost at seed stage, and definitely for a while pre-Series A. And so we came across a startup called Stake.rent.
Mhm.
And I can't disclose confidential numbers, but let's say it's one of the best investments we've ever made, right? And Stake.rent was founded by a guy called Roland Hobbs. He previously had run a few startups, which we like. He was very UX and design focused. And he had designed some of the loyalty programs for some of the world's largest brands. I don't want to get the brands wrong, but I think within that were names or similar names like Chase, United Airlines, some of the Marriott or some of the largest hotels in the world, right? And he felt that renters are not really treated with much respect. There's no such thing as a loyalty program for renters.
Mhm.
You have loyalty programs for guests, but why don't you have loyalty programs for the long-term renter? It was a really unique concept. I liked it. And so I went to the demo day of this accelerator. I think it was Shadow Ventures, I think, what might have been the accelerator that was showcasing stakes. I tuned in. It was like a 5 or 10 minute pitch, which is very difficult, right? But from that, I looked at maybe 10 companies and I thought, Stake seems really interesting. And I like the founder's passion, UX background. He wants to create this loyalty program, whatever that means, right? Okay. Got to understand the concept. Like when the founder comes up with a term like that, you don't want to dismiss it. You want to try to understand in the head of the founder, what is the founder seeing that I'm not seeing? So that got me excited. Um, Talk to the founder and he tells me, look, you should reward renters for doing actions like paying rent on time. I'm like, okay, why? Well, if they pay their rent on time, then you're not going to have delinquency issues. You're not going to have, through COVID, for example, lots of people weren't able to pay their rent,
Yeah.
relying on government assistance. And sometimes when you run a property, you give a concession. A concession means move in now and you get 1 month free rent. And he's like, don't do stupid things like that. Instead, say to the renter, if you sign up now, we'll give you $200 in your pocket. I think this is a really interesting way of looking at things. And so as I talk to Roland, I think to myself, okay, he's saying this, but this is really just an idea. How do we test this out? And so we own real estate conveniently. And so what do? I call up some of the property managers who manage our real estate, and we say, hey, look, I got this crazy guy, Roland, with some crazy ideas. Can you take a meeting with him? I take a meeting, they take meetings with him, and one of my property managers come back and says, "Oh my God, this is the coolest thing we've ever seen. We're rolling it out in your portfolio. And I'm also rolling it out in like other portfolios that we know of." I'm like, whoa. Now, for founders, you need to appreciate something, okay? When you're a
Yeah,
strategic
yeah.
investor,
Product market fit.
when you're a strategic investor or strategic VC, right? You're really looking for a strategic synergy with, whether you're a telco company or whether you're a real estate company. If your product is going to be used in my portfolio, I sort of have no choice but to invest,
Uh-huh.
right? Rationality goes out the window. I don't want to feel like, wow, I opened up a door for this startup. They're now being used in my portfolio, and I missed out on the opportunity to invest. Logic goes out the window, right? So I'm like hooked now. I'm like, oh my God, this is exciting. My property manager's using this, and we're actually producing traction for the startup. I don't remember the actual amount of potential traction, but it was significant, right? Pre-seed startup, we become a major pilot customer.
Yeah.
We have to invest now, right? So we invested in the company, and that startup has now been executing at lightning pace, and just you know, in the space of I think 1 year as of this podcast, they've grown their revenues 30x.
Uh,
Okay. We didn't expect that. And you're talking multi-million dollar revenues from a startup that is just pre-seed. They've launched a debit card for renters. They've launched like a current account for renters. They've suddenly become this platform that is not just providing not just providing fintech products for the underbanked segment. Your underbanked segment is renters. Renters have a net worth of $6,300. These aren't people you can easily, bank very easily. You can't sell products to. Turns out, I think about 8% of their users have never even had a bank account before. So now
so they're doing low income housing, you're saying?
yeah, low income housing. I mean, they can do high income, not high income like, average rent, but a lot of what they do is lower income affordable housing, and there isn't a solution for this. I just find out from them there's a multi-hundred-million-dollar fund that's being set up to go buy real estate and to offer stake rewards to users. Stake has become ESG is a buzzword that means like environment, social, and governance, right? Stake is becoming the S in that, the social part. We tick a box, we buy real estate, and we do low income stuff, and we give stake as a differentiator. I've gone to some of my properties that use stake, and I'm hearing from our managers, we're able to charge higher rents than other companies around us just because we offer stake and consumers love it. It's like a bank account for renters. So that's just one case study, but that's sort of a journey of how that came along to be. And then
And
five
in
minute
a
pitch.
scenario like that, what check size do you write?
Oh, I wish we put way much more money into this company. We put up overall in this company we've put $750,000. We started with like a 300K check, and
Uh,
we followed on at 450K, which is sort of how our fund operates. And sometimes when we're excited, we'll put SPVs together. We could be $1 million plus total check size in the company between seed stage and maybe follow-on stage.
okay.
So that's sort of where we play. And
So
if it's pre-seed, we might just do 100K.
okay.
Yeah.
What else you're excited about? What else you've invested in? Let's do another case study. This was a wonderful case study. I think the fact that you're able to do pre-seed investment and immediately bring customers into a deal is nothing could be better than that for the entrepreneur.
That's what I felt. I thought, why try to be another VC, trying to be a generalist, competing with Andreessen Horowitz and Sequoia and all these others? I thought, do I do a venture studio? No, let me actually set up a venture fund within a real estate company, so agreed. I do think we offer good value and it's been proven. It helps us too, it improves our revenues. I'll give you another case study and I'll give you this is like, just such a word as anti-case study, okay? Um, Sometimes this shows you that VCs have no idea what they're doing. They come up with all these criterias, and when the rubber meets the road, everything gets thrown out the window. This is an investment I made before I set up my VC fund. And I'm telling you this because sometimes we don't know what we do. We get lucky, okay? And really founder strength is all that matters. We have a rule in our VC fund. Um, we only do like pre-seed and seed stage and pre-series A. So not late stage, right? Late stage is like, I would even say where we operate north of $20 million valuations. For us, that seems late stage. I like the $5 to $15 million valuation range. And we don't like hardware. This is my rule, okay?
Yeah.
Now I can share these numbers because these numbers are public. I made a personal investment in a startup called Boxable, which is like prefab modular homes. And I didn't have any criteria except talking to this founder. He's just so much passion, so much excitement. He's trying to build like the Tesla for homes. I invested around a $40 to $50 million valuation. Okay. We looked at it at my VC fund and we passed on it because it was too late stage and it had hardware. Absolutely very easy pass.
Yeah.
Okay. And our thesis is if you invest early stage, you'll get insane 100x returns. This startup has been crushing it, like Boxable. And their most recent round was at 3.3 billion, and I only invested 18 months ago. It's been a 70x plus return for me.
Uh-huh.
I didn't think, like talk about FOMO. As a VC fund, we passed on a late stage company because it has hardware. We passed on it because we have to have a focus and we didn't believe you'd get good returns. How wrong were we? Right?
Yeah.
The strength of the founder is the only thing that mattered and the passion. And so I got lucky, like as a personal angel, right, in this investment. 18 months, that 70x type of paper return is great. But it just shows you like the
But
founder fit isn't that
I
important.
actually think that your criteria for your fund is still correct because
Yes.
you got lucky with Possible. You could not have got lucky also very easily, and I think for a smaller fund, early stage fund, trying to play that late stage game doesn't always pan out.
It does, and
Usually doesn't pan out.
as for Samana, you're right too, and maybe for founders, you might appreciate this perspective. When I'm making an angel investment, I just want to feel good, and I don't want to do too much work on it, really, right? And I'll just write the check. As a VC fund, you have to go to LPs,
Yes.
you have to get money from them, and they're going to ask you, "What's your strategy? Why are you different?" And so
What's
you
your
have to say,
investment thesis? Yes, of course.
yeah, so you say we only invest in these types of companies. Here's our model. Here's the stage. Here's the valuation. Here's the equity ownership we go for. If we had invested in Boxable, at that point in time, it would have been a stupid decision because we can all agree on this. Whoever's listening to this will definitely agree. It's much easier in theory to see a 100x return when you're investing at a $5 million valuation, right?
Right.
Than you are at a $50 million valuation. Just statistically speaking,
Absolutely.
the law of small numbers and baselines. So yeah, we would have it's like stories of some companies, and this happens today, my God, some companies are putting their treasury in Bitcoin, which is really, I appreciate it, but that's not what your shareholders are paying you to do, right? When I ran my company, I really felt like we should just take all our money, cash money we have. My company did really well. It's profitable. At one point we had like 100 million plus in our bank account. We're thinking, where do we park it? And I was like, can we just go put it in some Facebook call options? Theoretically, my company would have made billions of dollars if I did that, right? But I would have been fired as the CEO because we are not a hedge fund. My job is to run a company and to build a startup. In the same way, you have to have a focus, and if you go out of that focus, you're breaching your fiduciary duties. You're
Yes.
doing things that do not, I don't know how you describe it, Shimona, but it's,
Do you know what you're describing, Zain, is some of it is you're describing it in terms of fiduciary duties and your
yeah,
to your limited partners and so forth. But if you translate that same thinking to entrepreneurs, you have to focus. Focus is a good
yeah.
thing. Not having focus, not having any, you know, organizing principle in your thinking and how you want to go about building companies doesn't build good companies.
Yeah, and you need to set expectations too, and you need to sort of deliver on what you say. If your founders, if your investors are saying, "Look, we back you, you do whatever you want, just swing for the fences," then swing for the fences. But if you're saying, "I'm going to build X," unless you update them and you give them a really good plan, you're sort of, my view is return the money back. If your pivot isn't working, return the money back, unless your investors are on board with the new pivot.
Of the improvement, yes, exactly. We do a lot of pivots, but investors have to be on board with the pivots. Zain, it's a pleasure. It was a very, very entertaining and educational conversation. So I'm sure everybody enjoyed it. Thank you for coming.
Thank you so much. Goodbye.
Bye. So, folks, we're going to switch to the entrepreneur discussions. This is a safe working session. You don't have to be nervous. You don't have to be defensive. We're on your side. We're just going to discuss your strategy and try to help you accelerate your journey. And if you disagree with my feedback, that's fine. It's really, your venture. You do whatever you want. But there are principles, there are methodologies. We are in 2022. A lot of stuff have happened, a lot of learning and best practices have been formulated already. So if you go and do stupid things, you're going to have stupid outcomes, and please be aware of that. Crystal Williams, you are on.
Hi, how are you, Samana?
I'm all right, thank you.
Well, my name is Crystal, and I am the founder and director of Pathaway. Maureen did disclose to me this morning that it seems like I am a nonprofit organization, and you don't really support the nonprofit organization at the moment. But I feel that as many people that can hear my vision, that would possibly help get the word out and maybe get me some funding for the program.
Okay, so our community doesn't have the kind of funders that you're looking for. So that's what Noreen told you. We do for-profit ventures, so all our investors are looking for, for-profit businesses, and the investment terms and everything are aligned with that. Let's listen to what you're doing, and I'll try to be helpful, but it's not a great fit for us.
Okay. I just really don't want to waste your time if you don't feel that this is
Go ahead,
something.
you're here. Go ahead and tell us a little bit, and I'll try to point you in the right direction.
All right. Well, Pathaway was designed with the idea in mind to help reintegrate people from the inside out. I feel that we as a community go through so many traumatic things. Even now with Russia and Ukraine, we have a war going at hand and things like that. And I feel that individuals need to be rebuilded. The only way that we can rebuild individuals and build our communities is by providing resources. If we provide the resources that make families whole, that make individuals whole, then we can build better entrepreneurs. We can build better people for our communities to come out and bring these businesses abroad.
What do you do? Can you specify what do you do?
Well, me personally, at the moment, I am a nail technician, but I feel that for the services that I'm sending out, I do a lot of counseling and mentoring to young adults, people of all ages. At the moment,
Hold on. What is the value proposition of this nonprofit? Is it a mentoring service? Is it a counseling service? What is it?
so I was trying to head more towards the goal of providing all resources in one building and then expanding. All resources such as mentoring services, counseling services, educational services, maybe getting them involved in the community a little more to help them, evolve, providing food, shelter, clothing, things like that.
So the first feedback I have for you is that you can't do everything in one little company. Whether it's a
Not by myself.
No, and I mean, you'll have limited resources. So
Mhm.
for-profit, non-profit, whatever it is that you do, you're going to have to focus on a specific segment and offer a specific service. So if you're trying to, mentoring services, educational services, in what? What do you mentor in? Like, we provide mentoring services. We provide mentoring to entrepreneurs. And we provide mentoring to very early stage technology startups only. We don't provide mentoring to, women going through
Mental health patients and
right.
yes.
Very specific. And I would encourage you to come up with a very, very specific positioning. This is called positioning. Without a very specific positioning, I have not seen any organization succeed, and you will not either. So try to boil down everything that you are thinking about to one essential value proposition. What is your skill set where you have what we call an unfair advantage? And focus on that unfair advantage, focused on a specific category. So let me ask you, what target segment do you have expertise with mentoring?
Mental health.
Mental health for what age group?
Ages of 10 to 16, as well as 16 to 21.
Okay, so children and young and adolescents, let's say young adults, is where you're counseling, mentoring. And is it mentoring, when you say mentoring for mental health, what kinds of issues are we talking about?
We're dealing with traumatic events from adolescence, things that stop people from moving forward with life, things that cause them to feel inadequate to be a positive asset in society.
Okay, so then focus your entire plan on that, just that category, just that value proposition. Don't have this like grand, we'll do this, that, another, that. No, just that segment, just that value proposition, and see what you can create in terms of actually doing stuff.
For sure.
because otherwise I don't think you're going to be goods and supplies. You don't need goods and supplies to do this kind of mentoring. You know, if you just throw out everything that doesn't fit in that formulation, you will see your needs are much lower. You can get started right away. And you have to create some sort of a business model. Either you have to create a business model where people pay a small fee to you, or you have to create a business model where donors are funding, and you have to then look for donors who fund in that category.
Makes a lot of sense.
Fundraising is not that different in that sense from what we call investor entrepreneur fit in the for-profit venture world. Just like you just heard Zain talk about his investment thesis, he invests only in PropTech, in the real estate sector. He's not investing in fashion, for instance. He's not investing in cybersecurity. He's not investing in ad tech. He's not investing in fintech. He's investing in PropTech. So if you have a very specific value proposition, you can map it to a very specific set of investors who invest in that. So in the nonprofit world, this philosophy is going to apply as well.
Absolutely.
So that's my 2 cents.
I love it. Thank you. It was great information. It makes a lot of sense to me.
You're welcome. Folks, if you like what we do here, we do very precise work. We just like what I was just telling Crystal is exactly what we do. We kind of pare down your this, that, and other to the essence of what you should be doing from a business point of view, from a product point of view, from a fundraising point of view, from a customer chasing point of view. Everything boiled down to the essence is our philosophy. Laser sharp positioning. That's how you build great companies with limited resources. If you like this philosophy, if you like this way of operating, refer entrepreneurs to us and we'll be happy to work with them. Resources-wise, everything is on 1Mby1M.com. You will find a blog series that is free and very rich in the technology startup topic. And the Entrepreneur Journeys book series could also be a good starting point for your learning. There are 12 volumes of case study-based books. These roundtables happen every week. You're welcome to come as many times as you like. Hundreds of thousands of people have passed through this. Our full acceleration program is 1M by1M Premium, and we offer extensive methodology guidance. We offer you a very strong digital curriculum through which you can learn methodology. By the way, Crystal, even though this curriculum is primarily focused on for-profits, there's a lot of things you would learn if you just do the curriculum for a nonprofit as well, in terms of positioning, in terms of value proposition, in terms of how to sell and so forth.
Absolutely. Thank you.
Now, we also do business development. We have a terrific Rolodex, and that includes potential customers, channel partners, investors, media analysts, and we give you access to that if you're part of the premium program. There are caveats on financing. You have to become fundable before we make introductions, and we provide you with this kind of mentoring, consulting, coaching, whatever you call it, but interactive help, project-based help. Go to the self-assessment on the website and try to run your idea through this questionnaire. It is the due diligence questionnaire that VCs use. Also go to the blog and do the free bootstrapping course. It's less than 1 hour long, and it's an excellent, overview of early stage startups and how we go about thinking about building these startups. There's another body of learning material on Udemy. There are very reasonably priced courses, and there are many of these courses. You're very welcome to go start there as well. And in this we talk about the various kinds of bootstrapping methodologies that we use. We talk about domain-specific case studies and lessons from the trenches, whether it's AI or unicorn or, ed tech or healthcare IT. We have a whole How Investors Think series by stage, by region, etc. You can look at that. There's a lot of learning material. And then all our curriculum is available at 1M by 1M Basic. That's $99 a month. You're very welcome to learn there as well. So whatever suits you from a learning methodology point of view, we give you many options, and you're very welcome to get going with any of those. So dig around on the website. There's a lot of information about each of the different options of learning and engaging with 1M by1M. There's a lot of video FAQs, a lot of FAQs. The curriculum is described in detail, and it's an important piece because a lot of the methodology you are going to be learning is through the curriculum. It is a case study-based program. Thousands of entrepreneurs have been part of the case study program. And Zain, whom you just met, was part of the case study program. That's how we got to know him, and now he's an investor, etc. So we have a tremendous community around us of people who are, helping us with this project and generously contributing to this project. The investor introductions policies are available on the website as well. Please go through that if you're joining, especially the program in search of funding. Our methodology is lean, capital efficient, bootstrap startups. We believe in bootstrap first, raise money later. And our mantra is don't go to investors as beggars, go as kings. That is all. We have our free roundtables, 2 more in March. Next week, we do not have public or private roundtables, but after that, we resume. And we are ready for Q&A. If any of you have questions, you're very welcome to ask. I will introduce you to Irina Patterson as your contact after the session. If you are looking to ask questions about the program, you're very welcome to talk to Irina as well. All right, well, anybody, questions?
I just have one question, Samana. I was wondering if, because the nonprofit for me seems like a business in itself, but it's different when it comes to categorizing it. Would it be more beneficial to start it as a business and then turn it into a nonprofit?
Yes, my advice to you is going to not to worry about nonprofits and just do a business. There's a concept called double bottom line businesses. So 1 million by 1 million is a business. It's not a nonprofit. It's a double bottom line business where we, run it as a business. We charge money to service our community. Very reasonable money, but we are not free. We do a lot of things for free, like this is free, but there's also a business model around it. But we are also making a huge impact over a very long time in our community and in our space. So you may want to consider that as a strategy. And I think that would be a perfectly fine way to build a business. And in that case, you can join the 1M1M program, and I'll be able to help you through that as well.
I would love to do that. So if we can just keep in touch in that way, that would be something to consider.
All right. Well, join the program and we'll keep working on your business.
Thank you.
Welcome. Anybody else? Questions, comments? The public chat is available, and you can also use your computer audio to ask questions. Any of that is fine. I don't see any hands up. If you're also welcome to introduce yourselves. This is a good time to network. We always like to hear from who's in the room and what projects are you working on. It's a good little networking time also. No? Very quiet group then. All right. In that case, I'm going to adjourn the session for today, and we will see you in 2 weeks. Thank you for coming. Bye.
Blessings.